Actually, it's really quite straightforward because gold used to trade as a foreign exchange cross against the dollar. So the gold market has historically been manipulated by the United States to maintain the dollar's dominance in global reserves. So namely, keeping gold financial reliance on the debt-backed US Treasury securities. It was competing.
However, in a nutshell, and as we've been following for 2 years now, all this changed on the 1st of January 2023 when the Bank of International Settlements reclassified gold as a competing first-year asset class. For the first time in history, gold challenged the dollar's over 50-year exorbitant privilege, providing global central banks a sufficiently liquid alternative dollar investment vehicle that restricting the Fed's ability to fund its growing budget deficits. And this was the exact point the European Global South facing Bank of International Settlements short-covered the last remaining 500 tons right there of accrued gold swaps and leases, leaving the US and the UK central banks as the only remaining central bank trying to cap gold against the dollar into continuing efforts to tamp down a rising gold price rivaling the US dollar.
Up until the 1st of January 2023, Basel III compliance, spot FX gold had traded on an unallocated cash settled basis. And as with every other foreign exchange cross, long or short positions be cash settled amongst the Albanian market making bullion banks, with only a tiny percentage of these hundreds of tons of foreign exchange gold traded every day ever physically delivered. And the reason the remaining two central banks, which is the Fed, Bank of England, have not yet been able to comply with freshly instigated global Basel III NSFR structure, physically backed structure, where all FX gold positions have to be physically backed, basically, is because over 50 years of accrued price suppression, which required central bank physical gold to be borrowed and sold into the marketplace, has been scooped up by global-facing central banks on a one-way journey out of Western exchanges, never to return. It's gone. Worse, historically, instead of buying back the gold at a higher price and repaying these leases on a timely basis, it was common practice just to double down, borrow more central bank bullion in the hope of swamping the market with enough bullion to rig buying back lower. And you could do that before China came in and said, no way, baby, we'll take it. However, every ounce they sold into the market has completely disappeared. And as we highlighted in granular detail in our last episode, these Bank of International Settlement leases had to be repaid to the Bank of International Settlements at ever higher prices. But there was no way of buying enough bullion to repay 50 years of accrued, severely rehypothecated US and related Bank of England gold leases without triggering this revaluation event.
Now let's connect the dots even further, because the picture forming here isn't just a market shift, it's a seismic monetary reordering. What most people miss, or perhaps aren't being told, is that the structural change imposed by Basel III in January 2023 wasn't merely a regulatory update. It was, in effect, the demolition of a decades-old paper gold system, a system rooted in deception, opacity, and manipulation. With the reclassification of gold as a Tier 1 asset, the Bank of International Settlements sent a thunderous message across the financial world. The dollar's monopoly is over, and gold is no longer a mere commodity. It is money, real money. And with that stroke, every central bank that's been quietly accumulating physical gold is now holding the monetary equivalent of a lifeboat as the fiat ship slowly sinks. Consider this. For over 5 decades, the entire Western-led monetary system operated under the assumption that paper gold was good enough, that unallocated gold, traded via foreign exchange markets and cash-settled derivatives, would never need to be delivered physically. This illusion worked so long as the global monetary plumbing was intact. But here's the catch. Once physical settlement becomes necessary, which is now the case under Basel III's net stable funding requirements, the paper-to-physical mismatch becomes a liability of catastrophic proportions. Think about it. If you've promised ownership to 3, 4, even 5 different entities using the same 400-ounce gold bar, and suddenly those promises are called in, you've got a very serious problem. And this isn't speculation. We are seeing the real-world stress cracks already. Refiners across the globe are quoting delays of up to 12 weeks. We've got bullion banks offering 10% lease rates and still failing to source enough physical gold to meet their forward obligations. And perhaps most shockingly, even with the deployment of GC4 forward contracts, which essentially allow a form of double-counted leasing within vaults, the spreads between paper gold and physical gold haven't closed. That tells you everything. The market is not functioning properly, and when markets break down at this level, revaluation becomes the only path forward. So let's talk about that revaluation. What does that actually mean? Well, it's not just about the spot price hitting $3,000, $5,000, or $10,000. A revaluation is a recognition of systemic failure. It's the moment when the lie collapses and real value reasserts itself. Central banks understand this. That's why the BIS closed out its gold swap and lease positions, because they knew what was coming. That's why so many central banks, particularly in the global south, are demanding repatriation of their physical gold. They no longer trust the system, and neither should you. You have to understand, this isn't about price anymore. It's about control. Control over collateral, control over trust, control over what backs the currency. And if you're wondering why Western central banks like the Fed and Bank of England haven't met Basel III NSFR requirements, it's because they can't. You can't comply with a system that demands physical delivery when you've already lent out your collateral multiple times. The cupboard isn't just bare, it's a game of musical chairs. And when the music stops, someone's going to be left standing with nothing. Now, I know this might sound alarmist to some of you, but let's ground this in some very recent observations. Physical gold is being shipped from London to New York at a pace we haven't seen since the aftermath of the 2008 financial crisis. The very idea of tariffs on gold and silver, floated just recently, may in fact be a smoke signal, a way to disguise or justify the urgency behind these repatriation flows. Why else would central banks tolerate refinery bottlenecks, pay above-market premiums, or offer sky-high leasing rates unless they absolutely had to? This isn't about hedging inflation anymore. This is about ensuring sovereignty in the next monetary regime. And let's also address the elephant in the room. Fort Knox. Everyone's talking about it now. We're finally hearing calls for an audit of the U.S. gold reserves. Why now? Because when you start building a new system, you need to verify your base layer. The gold held by the U.S. is still officially priced at $42.22 an ounce. That's not a typo. It's a relic of the Bretton Woods era, completely divorced from current reality. Revaluing that gold even to $5,000 an ounce, as many experts believe is feasible, would unlock over $1 trillion for the Treasury without needing congressional approval. That's not just monetary reform. That's fiscal lifeline material. And make no mistake, once the U.S. does it, others will follow. The Eurozone, the BRICS, Japan, they'll all have to mark their gold reserves to market value or risk losing credibility in a gold reference system.
Now, look, no one knows the degree of rehypothecation relating to this 8,100 tons of US gold. People say, is it even there? Well, it's probably there, but who really owns it? That's the question. Therefore, it's not possible to estimate how much gold has to be bought back at market to repay these double ownership, triple ownership, quadruple ownership positions. And of course, there was been no audit since the 70s, so how does anyone know? One way or the other, unprecedented paper to physical exchange for physical spreads have exposed the paper to gold abyss. And the offer price to sell real physical gold will have to rise to an equilibrium level significantly higher than at current paper diluted prices. There's a massive gap to fill. However, in reality, as every central bank, sovereign and institutional trader knows, the massive paper gold to physical gold imbalance is exposed by these up to 12-week refinery delays. Defaults there are. Defaults. And even an offer of 10% lease rates to borrow central bank gold isn't incentivizing anyone to take that trade. Not even the ability to employ these GC4 contracts and forward promises allowing double ownership of local London bullion to remain in the vaults has adequately closed these EFP spreads. Yes, they've closed a bit, but there's a huge gap to fill.
Let's now shift the lens from just structural mechanics to what's really going on behind the curtain. A full-blown, deliberate monetary transition, what many are calling the silent reset. It's not theoretical anymore. It's happening in real time. The signs are there, clear as day for those with eyes to see. Massive gold flows, central bank activity off the charts, Basel III restructuring, paper gold cracks, and all of it unfolding while the mainstream media acts like it's just another Tuesday in the markets. If you're watching the headlines, you're already too late. If you're following the gold flows and what central banks are doing with their vaults, then you're ahead of 99% of the world. Let's talk about this new paradigm, what some call the endgame. Gold is no longer being treated as a speculative asset. It's being treated as settlement collateral. And when a financial asset crosses that line, it's not priced like a commodity anymore. It's repriced like money. The revaluation narrative we touched on earlier isn't speculation, it's strategy. Physical gold is being drained from London vaults into New York, Switzerland, Istanbul, Singapore. And no, it's not hedge funds doing this. It's sovereigns. It's central banks. It's the ones that already have a blueprint of what's coming. The message they're sending is loud and clear. Gold is going to anchor whatever comes next. And now consider what's happening to the COMEX system. Yes, the exchange that for decades has been the central mechanism for gold price discovery, or more accurately, price suppression. Traders are standing for delivery in volumes that were unheard of just a few years ago. Banks are scrambling to fill orders, offering cash premiums, delays, swaps, anything but physical gold. And those long COMEX positions, they're no longer just spec trades, they're delivery demands. And that changes everything. It turns what was once a paper game into a physical scramble. Meanwhile, the average investor is still caught in the illusion that spot price equals real price. It doesn't? Not anymore. The real price of gold is the price you pay to acquire physical delivery, and that's diverging from spot. That's your signal. When the two prices start to dislocate, you're witnessing the beginning of what we call price discovery failure. And once price discovery fails, the market resets on physical demand. That's when gold jumps, not gradually, but in a gap up. The kind of move that happens over a weekend. The kind of move that changes the trajectory of wealth for those who are positioned and leaves the rest scrambling to catch up. Why is this all happening now? Because the debt-based system is cornered. The dollar cannot maintain supremacy with this level of debt expansion, interest cost, and geopolitical blowback. When you can't grow out of debt and you can't inflate it away without sparking a confidence collapse, the only remaining option is to collateralize it. And the only global collateral with no counterparty risk is physical gold. Let's be clear, this isn't about replacing the dollar tomorrow. It's about anchoring credibility in a system that has none. That's why the BIS made gold a Tier 1 asset. That's why the central banks are scooping it up at the fastest rate since Bretton Woods. That's why nations like Russia and China are pushing for a multipolar reserve structure. They're not betting on Bitcoin. They're not betting on fiat. They're betting on metal. Hard, cold, deliverable metal. And what about silver? That's where this story gets even more explosive. If gold is the foundation of central bank balance sheets, silver is the shadow asset that will catch fire the moment gold breaks the $3,000 to $3,500 range. Why? Because silver is a monetary metal that the system deliberately tries to ignore. It's used industrially, yes, but when the monetary panic hits, when confidence cracks in fiat, silver becomes the people's money again. Historically, it always has. It's small enough to be accessible, liquid enough to trade, and scarce enough to spike violently. And yet no one is paying attention. That's the irony here. The most important transformation of our monetary system is happening in slow motion, and the public is distracted by memes, stocks, and sports scores. They're sleeping through the biggest gold and silver accumulation event in modern history. Let me put it this way. The richest, most connected, most informed institutions on Earth are not buying gold to speculate. They're buying it because they know the current fiat experiment is on borrowed time. Still, people ask, but when will it happen? The answer is that it already is. You're living through it. The revaluation doesn't need to be announced. It's occurring one sovereign vault at a time, one closed ETF redemption at a time, one refinery bottleneck at a time. And eventually, like all monetary shifts, it will go from gradual to sudden. There will be a trigger, perhaps a geopolitical crisis, a failed treasury auction, a banking shock. But the groundwork is already laid. When it does go, it will go violently. Gold and silver will reprice in a matter of days, not months, and it will not be a rally. It will be a repricing of risk across the entire financial system. So what should you do? Own physical, take delivery, get it out of the system, stop thinking in terms of dollar price, and start thinking in terms of ounces. Ounces don't default. Ounces don't get rehypothecated. Ounces don't lie. And that's the real asset class of the future. Truth. You cannot lie with physical gold. You can't manipulate it once it's out of the system. You can't fake possession. You either have it or you don't. And in a system drowning in illusion, gold and silver are the only truth left. Remember, they want you to focus on the price, but price is a distraction. Positioning is everything. The banks, the sovereigns, the BIS, they've been positioning for years. The vaults are being emptied. The flows have reversed. The final squeeze is coming. And if you're not physically positioned by then, no ETF, no futures contract, no digital IOU is going to save you. It's not a conspiracy. It's a reckoning. And when the dust settles, those holding ounces, not promises, will be standing on the other side of history, not just with wealth preserved, but with purchasing power multiplied. So ask yourself right now, are you where you want to be? Do you hold real money? Or are you still waiting for permission from the media to act? Because by the time they sound the alarm, the revaluation will be over. The game will have already changed.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.